Hello and welcome. Today we're working on making adjusting entries. We're working on a problem called ACE Consulting, where I have previous videos on making journal entries and figuring out the balance of each account. So look at our accounting cycle. We've made journal entries, we've posted to the ledger and figured out the accounting balance. The previous video we did the trial balance, showed how to do the trial balance from start to finish. So here in this video we're going to do the adjusting entries and the adjusted trial balance. Now, over time, over the month, things change. So here we have a trial balance at the end of the period. And so we have assets, we have liabilities, we have equity, we have one revenue account, and we have 3 expense accounts. So this lists the balance of each account. Now we have a few things that have changed over time. We don't make daily entries on some of these. And so things that happen that change over time would be insurance policy we slowly use up. So we have about 5 adjusting entries. We're going to make the adjusting entries and then we'll do the adjusted trial balance. Update all the balances to get our new adjusted trial balance. Now, once we get the adjusted trial balance, the next video we'll do our financial statements. So this is all a part of the accounting cycle. I want you to see this one problem all the way through. I've got several videos on this. So let's get started on our adjusting entries. The insurance policy was purchased at the beginning of the month and it's for 6 months. All right, so what is our prepaid insurance? Remember we made an entry for prepaid insurance, $1,800, that's for 6 months. So we have an $1,800 asset that we know gets used up here 1 month. If we take $1,800 divided by 6, that's $300 per month. So we're going to make an entry that says insurance expense, and we're going to credit the prepaid insurance. So our prepaid insurance is going to be reduced by $300, so it's going to be $1,800 minus the $300. It'll have a balance of $1,500. And we have a new account. Let me just start doing some of this here. So insurance expense is just going to be the $300. So we're going to debit insurance expense $300 and credit prepaid insurance for $300. This recognizes that we have insurance expense and we have a smaller asset than we did before. All right, so that is an example of if you have insurance and slowly every month we'll make that entry. So we'll make that entry for 6 different months until we have to purchase another 6-month policy for our insurance. All right, number 2, during the month, ACE performed consulting services and earned $2,000 of the unearned revenue. Okay, now how do we get unearned revenue? Let's go back and look what we have. Unearned revenue says a credit of $3,200, but it's in the liability section because it's a liability. Someone prepaid $3,200 because they want consulting services from us. They've prepaid, and we later then will give them that service, and we only earn it when we do the work. So what happens is we have unearned revenue. Let's just set this up here. Unearned revenue, and the amount is $3,200, and we've earned $2,000. So what entry would we make? We would debit unearned revenue and credit the service revenue. Remember, the definition of revenue is we only recognize revenue when we earn it, not when we receive the cash. We could receive the cash ahead of time, during, or even after the time. So we're going to debit unearned revenue for $2,000. So now it has a balance of $1,200. $3,200 minus $2,000. The balance of unearned revenue is $1,200. That's our liability going forward. All right, so service revenue, then we get to recognize an extra $2,000. The next one, the equipment was purchased at the beginning of the month. Let's look at equipment. I believe it's for $5,000. The equipment is for $5,000. And let's just assume the equipment was purchased at the beginning of the month. Depreciation we estimate is going to be $100 per month. All right, so what do? Well, this is a little bit unique because equipment has a long life, like 3 years, 5 years, 10 years, whatever. So we're going to debit an account called depreciation expense. And we're going to credit an account called accumulated depreciation. I'm going to write it all out here. Dash equipment. All right, so what's our debit? What's our credit? Depreciation expense is 100, and our credit is going to be accumulated depreciation equipment. Now, we kind of understand what depreciation expense is. It's an expense. But what is accumulated depreciation? Well, this is a contra account that's going to reduce the equipment account. So instead of directly going to the equipment account, we're going to go to the accumulated depreciation dash equipment, and we're going to put in 100. So the balance of equipment is 5,000, and the balance of the related accumulated depreciation account is 100. So it's going to show in our books as a net of 5,000 minus 100, or 4,900. We're going to show it that way on the balance sheet. We'll see that the financial statements on the next video. All right, number 4, at the end of the month, wages have accrued for 900. All right, so now when you go to work, you understand that you don't get paid ahead of time. On Monday, when you show up to work, they say, okay, how many hours are you going to work this week? Okay, we're going to pay you that times how much you make per hour. They don't pay you ahead of time. They say at the end of the week, how much did you work this week? And then we'll pay you maybe next week, right? So you work and you get paid later on. You understand this. So for a business, if you work in September, then that's an expense of September for the business, even if they pay you in October. All right, so what entry would we make? Wages expense. What do we credit? Wages payable. It's a lot like accounts payable, except we know it's for wages, and it's going to be for $900. $900. So wages payable is a new account we haven't seen, but wages expense, we just have an extra amount of expense. This is a real expense, even though we haven't paid cash yet for it. So our wages expense, let's look at this just for a second. Our wages expense are $1,200. Our wage expense is $1,200, and now we've added $900, so the balance of wages expense is going to be $2,100, right? So our expenses are a little bit higher than we thought based on what we see here for the wages. All right, our last one, our supplies has an ending balance of $400. And you kind of think, well, hey, good for you. Well, what does that mean? Well, if go back and look at supplies has a balance of $4,600. Supplies is $4,600. All right, and we're saying we counted it and we have 400 left. So what's happened? Well, we've used up some amount, and we can easily figure out how much it is if we take the 4,600 minus the 400. Then we say we must have used up 4,200. What do you call it when we use up supplies? Well, we're going to call it supplies expense, and we credit the supplies account, and it's for $4,200. So we have a few extra entries at the end of the period to show things have changed. These are our adjusting entries. Okay, so now we're going to take the adjusting entries and kind of plug them into our trial balance. So here's our trial balance. I just kind of recreated it here, and I'm just going to make it easy. We could have done this directly, but I want you to see what's going on here. So let's take each entry and kind of drop it here in the middle, and let's figure out the balance of each account. Now, not all accounts are affected, so we're just going to pull the ones that we need. So let's go back to our beginning. We had insurance expense and prepaid insurance, $300, the debit and the credit. Insurance expense, we don't have an insurance expense, so let me add an insurance expense here. So here, Insurance expense, how much is it for? It's for $300, is that right? $300 is insurance expense, and prepaid insurance is going to be a credit for $300. So we made a debit and a credit, and I've already created the sum function. Just typed in sum and the entire thing. Let me show you how to do this. Sum, start of parentheses, and this entire column. Close the parentheses, and you see we built a formula up here. Built a formula, so sum equals E3 to E16. Excel is your friend, so I always use Excel to show things, but also when you're working on numbers like this, it's easy to change the numbers. So I'm going to hit enter, and this entire column is going to be summed up, whatever numbers go in there. All right, so we got our first entry in. Our next entry is unearned revenue. I never put the number in. Unearned revenue of $2,000 and $2,000. Unearned revenue of $2,000 and service revenue of $2,000. So we've recognized revenue of $2,000, right? And I try to show it here. So unearned revenue, I'm going to debit for $2,000 and recognize service revenue for $2,000. All right, the next one down, we have depreciation expense and accumulated depreciation for $100. Now both of these, I don't think we have either one of these here, right? So we're going to have to add a depreciation expense. The depreciation expense, it's going to be in the amount of $100. And we need, below the equipment account, we need to add accumulated depreciation dash equipment. And it's going to be for a $100 credit. We got our debits and credits still. You see we still have debits and credits will equal here. Our next one here, we've done the first three. We have two more to do. We have wages expense and wages payable, $900. Wage expense and wages payable. I already have wages expense right here, so I'm going to add $900 to that. And wages payable up here, we have two liabilities. So I'm going to put another column, another row in rather. So wages payable, and it's going to be for $900. That's another liability that we have. All right, our last one, supplies, has an ending balance of $400. So we have supplies expense of $4,200, and supplies is $4,200. I don't think we have supplies expense. So let's add supplies expense. The amount is $4,200, and we have supplies that goes down by $4,200. All right, so I'm kind of rolling off the screen a little bit, so let's see what we can do. Let me make it slightly smaller. That might be helpful for us. Hopefully you can still see that. So for our cash, we're just going to bring that amount over. Cash. Accounts receivable, bring that over. Now supplies is going to be $4,600 minus the $4,200 because it's a debit and a credit, right? Same thing here for prepaid insurance. It should be $1,500, right? Equipment is just going to be $5,000. Accumulated depreciation is going to be the $100. The accounts payable is going to be the $1,200. The unearned revenue is going to be $3,200, a credit, minus the debit of $2,000. You see why we use debits and credits here? The pluses and minus. So the wages payable is going to be $900. The common stock is still going to be $12,000. The dividends are still going to be a debit balance of $250. Our service revenue is going to be the $9,500 plus another credit, $2,000, so $11,500. Okay, supplies expense is going to be the $4,200. Depreciation is $100. These need to be debit, sorry. So, supplies expense $4,200. Depreciation is $100. Insurance expense is $300. Wage expense is $1,200 plus the $900 is $2,100. The $400 just carries over, and the $1,500. All right, if we did this correctly, then what we should have is we should have our debits and our credits equal. We feel good about this. We have debits and credits equal $26,900. We now have not only the trial balance, we have the adjustments. And so the adjusted trial balance would be all these accounts and all these amounts in the far right columns. So let me highlight this just a little bit. So our adjusted trial balance shows that all our debits and all our credits equal and listing all the accounts and all the amounts. So now we're ready on the next video to do the financial statements. Hey, thanks for watching. We'll see you on the next one. Good luck in accounting.